we have got about 3 ways of starting accounting as a subject when you're doing it for the very first time. We have got an approach where you start it through the basic accounting equation, and then you develop it to the double entry until you get to the financial statements. Another approach is when you use the balance sheets approach. That is the statement of financial position. You start from the bottom until you then do your double entry system. And then the last approach is the general approach. You start there, you post to the ledger, and so on and so forth. Now, in this table that I'm showing here, we are going to be looking at the steps that we follow. If it was an organism, where does it get born? What are the growth processes? And where does it die? So that's the steps. And then here we'll look at the action that needs to be taken at a particular stage. I would have preferred the word action there, but your syllabus uses the word step. And then evidence, right? This shows what do we need in order to complete that step. And then how often is that action supposed to be taken? You find that some things must be done as and when they occur. Some you may do them daily, some you may do them monthly, and some of them you may have to do them at the end of the year. That's annually. So, ladies and gentlemen, let's start from the very beginning. Our very first step, step number one. Step number one is the issue of recording. When a transaction takes place, it has to be recorded. I would have loved the word captured, because when you have a transaction taking place, it has to be captured so that it doesn't escape. You don't lose it. But they are preferring the word record, which is fine. So when there's an exchange of value, for the business not to forget, they need to capture it, they need to record it. And how do they capture that? They capture it through what are called source documents. Traditionally, we refer to this source document as business document. But in accounting, we use the word source because when we have got these documents, they now provide us this, they now act as the source of information we require for the next steps. And how often do we use these source documents? Right, it's immediate. In other words, in real time. So the first step is this where we capture transactions as they take place using source documents. And if you look at the frequency, it has to be in real time. Why? Because we don't want to lose any of those transactions. And we use source documents. Traditionally, these are referred to as business documents, the likes of your invoice, your paid vouchers, your general vouchers, your paid voucher. You can also talk of your credit notes, your debit notes, your in the past when you used to have checks, your check counter for your check stub. You may even talk of your EFT slips, and you can also talk of those slips that are generated at the point of sale. So those put together are referred to as your source documents. So now let's get to see the next step, step number 2. So step number 2 is to enter journals daily. So you must prepare journals daily. Remember, journals are diaries. You diarize what would have taken place on a particular day. That's why we say we do that daily. So the source documents provide us with the information we require to set up the journals. So on a real-time basis, the information will be captured through the source documents. And at the end of the day, you classify the source documents into different groups. Your receipts will be together, your invoices will be aside. If it slips will also be on this side, debit note, credit note on the side. And then from each group, you'll then be able to set up a specific journal for that group of transactions. And this is done daily. And this responsibility is the responsibility of a bookkeeper in the sense of a business. And then step number 3 is once the journals are set up, you will then have to post them to the ledger. At some point, ladies and gentlemen, when we really do this properly, I will expose you to the different journals. You need to know that we do have different types of journals, the cash journals and the credit journals. You need to know what we record in specific journals, because the transactions we have will determine the journal that you're going to be setting up. So if it's going to be cash payment, we'll talk of the CPJs. Cash receipts is going to be CRJ. Pet cash is going to be pet cash journal. And returns, you're going to have to talk about the sales returns journal or data allowance journals and so on and so forth. But for now, let's just group them together. We call them journals. And then the third step is when the journals are completed, you post them to the ledger. And this part is when you complete double entry. And now, once you have done that, you then prepare what is called pre-adjustment trial balance. A trial balance is a tool we use to check if our ledger accounts are correct. What do we check there? We check our arithmetic accuracy. Remember, we are saying double entry suggests that the two sides of an account must always be equal. And therefore, the totals in the books must always be the same. And for us to check that is to take the debit accounts and the credit accounts, check the totals. If the two sides are not equal, then it means that we have been wrong. And the tool we use to do that check is what is called the trial balance. It's an archaic word stemming from the understanding that you have to try the balances until they agree, hence the name trial balance. And this first step of checking your accuracy is called the pre-adjustment trial balance. At some point, you'll understand why we say it comes before the adjustments. And then after that, we do the adjustments. If we get additional information relating to our accounts, and those adjustments will also lead us to a new group of ledger accounts that are updated now. And this is done annually. And once that is done, we do what is called post-adjustment trial balance. We'll explain at some point what that means. And then we then go to step number 5, where we are saying to ourselves, we do have some items that are supposed to go to the financial statements. And these are called your nominal accounts. We'll explain what nominal accounts are at that point. And then we prepare what is called a post-closing transfer. Post-closing trial balance, sorry. Remember, this one is the post-adjustment trial balance. This one is the post-closing trial balance. These are the steps that we're supposed to be following. At the end of, you must end up at step number 6, where you are now reporting all the information that you have been collating. And these reports come in the mold of what are called financial statements, and these are done annually. So we will show you these steps until with the end product, which will be interfacing with the stakeholders, and that end product is what is called financial statements. If you are in a company, you will be said to present during an AGM what we call annual financial reports. It is a process that is supported by the Companies Act. It is the responsibility of the financial director in a company. So if you're an accountant in a big company, you're not the man. You are actually a tool in the big man's office, and the big man is the financial director, whose responsibility is to present the annual financial report to the stakeholders. And the major group of stakeholders is the shareholders. And these statements, if it's for a company, they can't be presented before they are audited. That's why you get to talk about an audit report prior to presentation. All right, at some point I'll explain how that works up, different types of audit reports and what they mean to the stakeholders. But